All right, afternoon. Welcome back to the Share Series hybrid event. I'm Kyle Joseph with Jefferies, and I'm pleased to have with me Douglas Lindsay, the CEO of Aaron's, and Kelly Wall, the CFO. At the end of the session, we can open it up to questions from the audience if there's time remaining. But with that, I'll kick things off. I think quickly just introduce yourselves specifically, and then we'll get into kind of the company as well and give your history and how you got to Aaron's.
Sure, yeah. I'm Douglas Lindsay, the CEO of Aaron's. I've been with Aaron's since 2016. I came in as president when Aaron's was combined with Progressive Leasing. We spun out in 2020 and are now a standalone company, at which time I became the CEO. And we've been working on a 7-year transformation of Aaron's, which we're really proud of to share today.
Kelly Wall, the CFO. I joined Aaron's back in 2017. I led the team through the spin as interim CFO of the combined company before, and have been the CFO of Aaron's since completing the spin at the end of 2020.
Great. And then, more specifically, obviously there's a lot to get into here, but Douglas, if you just, for those that are not familiar with the story, give a sense for the history, the size, what exactly lease to own is for those that don't know, and kind of more recently some of the channel diversification in terms of e-com, and then we'll touch on BrandSmart later. So
sure, yeah. So Aaron's has been around since 1955, and Aaron's is a rental company. So we rent furniture, electronics, and appliances to those who have fewer other credit options, and we're really proud of what we do. We serve a large segment of the population, about 1/3 of the population, through a rental transaction. And in that, we have about 1,000 company-owned stores, about 234 franchise stores. We're vertically integrated. We have our own fulfillment centers, and we manufacture our own furniture through a brand called Woodhaven for the rental market specifically. In addition, in April of 2020, we bought a retailer called BrandSmart USA. BrandSmart is a leading retailer of value-oriented appliances and electronics. We service a very broad consumer demographic from subprime to super prime, anybody that's really looking for value. We've competed traditionally in Florida and Georgia and have a real lead in our brand positioning down there. And we're really excited about that business. We bought it in April. It was on the back of some compelling synergies, but also growth opportunities, and we plan to open 1 to 2 stores a year with that brand. In addition, with both brands, we've got a growing e-commerce business, and we'll continue to talk about that as we go on.
All right. And then I think it'd be helpful, walk us through the lease-to-own model and how your P&L kind of differs versus a more traditional retailer.
Yeah, so the lease-to-own business, specifically Aaron's, about 90+% of our revenues are lease revenues, and what that means is we've got a lease. A customer comes in and they enter into a lease agreement with us. It's a rental agreement. It's a 30-day contract, but they can sign up for paying us every 30 days for 12, 18, or 24 months. When they complete that payment up to the 12, 18, or 24-month period, they own the product. So what that means is a rental agreement. We own the product in the consumer's homes, and then they obviously can own it. Part of the value proposition of that is when they rent the product from us, we deliver it and set it up for free. We service it over the life of the agreement. They can choose to return the product at any time and are good for the payments they've made into the product. And if they choose to come back and rent that product for us again, we pick up where they left off and try to get them to ownership, which is a really great value proposition. What that means for our revenue is that we've got this large recurring book of business. You'll hear me talk about lease portfolio size. We have a $126 million receivable that is our lease revenue that we collect every month, much like a health club or another recurring business line that you heard about earlier. Every month we get up and we try to renew that customer and get them to pay their lease so they can have the enjoyment and the benefit of that product going forward. We do that in a number of different ways. We do it through our stores, we do it through digital platforms, and we do it through our e-commerce site, and we're really proud of what we do there. This business is very different. We live at the intersection of retail and consumer finance, but unlike retail, we have this embedded recurring revenue that goes on.
And then, so you guys mentioned the split from, or the spin, I should say, from Prague Holdings back in 2020. Can you talk about, what's changed for the business and how you think about it, operating it as a standalone entity versus kind of what was the partnership with Prague before?
Sure. We had a great relationship with Progressive. We brought Progressive in 2014. Progressive was a lease-to-own business through a retailer. It was really a B2B business. We're a direct-to-consumer business. We serve about 1 million active customers, and we do it in a way that's uniquely ours. Really, we're running the same business we did when we had Progressive. We were very much separated in our operations. The one thing that has changed is our capital allocation. There's a lot of capital that is, we have strong free cash flow. We generate about $150 million a year in operating cash flow with about 30 to 40 million of maintenance CapEx. That leaves us a lot of additional cash to deploy into the business. As we think about capital allocation decisions, we are now thinking solely about Aaron's and what we can do to make Aaron's better, more relevant, and more competitive as we go along, instead of sort of sharing, if you will, the piggy bank with several different companies at a time with the capital allocation discussion.
Okay. And then I think it'd be, the last 3 years have obviously been relatively unique, but can you walk us through, recap the business performance in the pandemic, stimulus, et cetera, and kind of how the business is emerging on what feels like hopefully normalization?
Yeah. Well, I mean, listen, the pandemic was very challenging. We made the decision at the time of the COVID outbreak to close our stores. And as we did that for the benefit of our customers and our team members, we then began to do a phased reopening, and as stimulus kicked in, I would say our trailing EBITDA was right around 150 million. As stimulus kicked in, we saw a huge surge in demand as our subprime consumer was more liquid. The subprime consumer, typically we do well when they have cash and are liquid. And unlike other credit businesses like lenders or other things, we're in the leasing business and we lease products. So when people have money, they tend to buy for their homes. And so they were buying refrigerators, sofas, TVs, et cetera. In addition to a delivery spike, we also saw a what we call renewal rate spike. The number of people renewing their leases or on-time payments, collections, if you will. That jumped up from historically being around 87, 88%, all the way up into the high 90s. And every point of collections is worth about 15 million of EBITDA to us, and that's 100% margin revenue. And so when we saw that, we saw our revenue in our EBITDA in 2020 go up to 234 million. That has since normalized as stimulus has come off. And as we've began to see high inflation, our customers become under more and more pressure. And so, we continue to monitor it. We work with our customers. One thing we do in our business is we're there for our customers when they need us. But we have gone through a period of stress where discretionary income to buy products is more challenging, where payments have become more challenging, and the pull forward of demand has left us with a little bit of a challenge here at the end of the year. Our outlook reflects more normalization as we go into 2023 on the demand side, more towards the tail end of the year. And on the collection or renewal rate side, we're beginning to see progress there with our first quarter. I think we said on our call, approaching pre-pandemic collection and charge-off levels. So that's very positive.
Okay. And then can you talk about underwriting? I think you guys centralized it during the pandemic, and how your underwriting has evolved over the last 3 years, and pandemic and post-pandemic.
Sure. Yeah, one thing we're really proud of is, so I started in 2016. We undertook a transformation journey that is now 7 years in the making. There were several things we wanted to do: make our retail experience more relevant, digitize our overall experience for the customer. But one of the most important things was how we originate the customer. Used to be you'd walk into an Aaron's store and you were greeted with someone with a clipboard. They'd take all your information, you'd pick out the product you wanted, you go and sit in a room, and we would process an application, come back with a yes/no decision, try to get you into a lease and get that product delivered to you. We now do that digitally through very few fields. That process used to take 60 minutes. It now takes a handful of minutes. In many cases, you're approved before you walk into our store through a QR code. You respond to an advertisement, or you apply in our kiosk, or you apply online. 20% of our deliveries now are online, and we're getting people approved right away. So when the pandemic hit, we were like 200 stores of our 1,300 stores into that process. We had tested it, we had validated it, and we were able to roll that out immediately. What this does for us is a game changer in rent to own. We used to run a very decentralized business. We now have a scoring spectrum for our customers that allows us to look at profitability and approval rates. We approve people for a certain amount based on their ability to pay, and we can cut off at various levels of approvals based on how the economy fluctuates up and down, which is effectively like putting the business on power steering versus manual steering we had before.
Got it. You touched on this, but kind of give us in terms of e-com, when you guys really started not putting the pedal to the metal, but really focusing on e-com, where you see the balance of e-com versus store over time, the growth trends there, and then also, give us a sense for customer demographics and whether you're servicing the same customer, a different customer.
Yeah, e-com has been a very, I think, back again, I'm benchmarked back to 2016. E-com was less than 5% of our business. It's now 16% of our revenue and 20+% of what we write into our portfolio. And this is a question that Kyle asked earlier that I may have not fully explained. This recurring book of business, we write in what retailers would call their sales. So we write into the portfolio this recurring revenue, and then revenue churns out. And what e-com has allowed us to do is write more revenue into the portfolio by reaching the customer through other channels. We've also expanded our product assortment online. We now have over 8,000 products online, which has been massive growth. We've developed an engine to approve people online. I believe we were the first fully transactional rent-to-own company doing e-com. And importantly, we have on our roadmap unified decisioning, which will allow people to effectively get approved online in a different way than most other retailers can, and allow them to shop more broadly for products they want, which is really interesting.
Got it. And then we touched on this briefly, kind of on the heels of the pandemic, but kind of give us a sense for the overall health of your consumer. Obviously, unemployment is low, inflation is high, a lot of different things going on there. And then also kind of walk us through, the state of the consumer at your Aaron's consumer versus BrandSmart as well, to kind of.
Sure. I mean, it's been challenging for the Aaron's consumer. If you imagine you're a customer who makes $30,000 a year, and you've got inflation and your food and your shelter and your car, everything else, there's just not a lot left for discretionary payments. And so, those that serve this customer out there are really, trying to take share effectively, because there's not a lot of new business to be had. And people we sell necessities, essentials for the home, and so there's a need out there. We just have to be better than everybody else. And so we're trying to have the best looking showrooms, the best technology, the best price, most importantly. And we survey our customers, and they say price is most important, but also flexibility to work with them. We're in a relationship business. I often say it's consumer finance, it's retail, but it's also hospitality. We work with our customers, we know our customers, and we want to set them up for success, and we think that's what differentiates us. Where I see the customer going right now in this inflation environment is they're acclimating. Effectively, their wages are catching up with the sort of sticker shock they've had from inflation, and that acclimation's working. But at the same time, we're controlling our decisioning. We've tightened our decisioning by several hundred basis points, meaning we went from kind of what you call mid 90% approval rates down to probably high 80% approval rates. And that's really set those customers up for success. We've also sized them for the right size payments to allow them to manage through this period of time. I do believe over time, our market is set up to win in a credit tightening environment. This has not happened for a very long time, probably since 2008 or 2009, where we've seen near prime and prime credit tightening. But when that does occur, customers looking for other payment options. They don't have the money to come out of pocket for a $1,500 appliance, and they're looking for a payment, and there's not a lot of credit providers out there. We can provide them the product on a rental agreement, much like they would pay something with credit over time, and give them optionality to return it anytime they want.
Got it. One last high level before we kind of get into the long-term strategy. You talked about the availability of credit, obviously as a form of competition, but give us a sense for kind of the LTO competitive environment specifically, and how this has changed over the years.
Sure. I mean, historically, lease to own was direct to consumer, done through a retail environment. You had folks like us. We're in the monthly payment business. We have a slightly higher income customer. We have larger stores. Each store has on average 850 to 1,000 customers, and we take payments monthly. The other part of the space was the weekly players, Rent-A-Center, Buddies, a couple other big ones that are public in that space. They do a weekly payment and collect over a weekly basis. They typically have smaller boxes and have higher churn in their business. They get to about 400 to 500 customers per box. What's happened over the last decade is the advent, so they're over here, we're here in the middle, is the advent of virtual rent-to-own. And that is getting a rent-to-own transaction in a retailer. For example, going into a Best Buy, you apply to Synchrony, you apply to Fortivo, you get denied credit. A virtual rent-to-own provider will go buy the product from Best Buy. So Best Buy saves the sale, and they will put it on the lease. They own the product, the virtual rent-to-own provider, and they collect on it over 12 or 18 months. And so now that customer can be acquired through a retailer versus having to come find us. And so how we've pivoted is we know we have a price advantage because they're paying at retail and marking up over retail. We buy it wholesale, and we can spread over 24 months because we have tentacles through our stores and trucks, and this embedded infrastructure we have to go collect on the customer. So we can lower price below the virtual guys and have better relationships. That's a very competitive space. One thing we've realized over time, and I'm sure Kyle will ask me this, is when you're in a retail, you have much more selection than we have in our stores. So we've begun to pivot our stores to have larger, more relevant selection, to be brighter, more modern showrooms, and to compete with the retail, not what you might think of as the old rent-to-own model.
Got it. Okay, thanks. And then on the fourth quarter call, you guys talked about an extension of your long-term strategy. I think about it as a three-prong approach between Aaron's, BrandSmart, and cost optimization. Can you just give us high level, what you updated and then how you're thinking about your multi-year strategic plan?
Sure. There's three pillars: transform the Aaron's business, enhance and grow BrandSmart, and drive cost efficiency in our business. The first two are really growth engines. The second is an efficiency driver. At Aaron's, what we're trying to do through further transforming Aaron's, is market optimization, having fewer, larger, more relevant stores in our new Gen Next model, which is sort of splashier showrooms, better product, better customer experience. Two is to have a hub and spoke relationship or hub and showroom relationship with our core stores and growing tentacles outside of them. And I'll talk about that here in a second. It's both a growth objective and a cost takeout objective. Three is to build our e-commerce business from where it is now to 20% of revenue by 2025. Fourth is to compete against the weekly providers and offering a more flexible payment solution on a weekly basis to customers who maybe didn't know we would approve them, but at a more compelling value proposition than the competition, and to take share. And lastly is to continue to enhance our decisioning and servicing platforms. We think that's a key differentiator. On BrandSmart, we're only in the tip of Florida and in Georgia, so we believe there's unit growth to be had there. We only have 10 stores. Every store we add is 10% growth. And we believe we're well known in the Southeast, particularly in Florida, and we plan on growing 1 to 2 stores a year. We bought that BrandSmart in April for a reason. We think they're compelling synergies, and we plan to extract procurement synergies, e-com synergies, and lease-to-own synergies there as we replace the previous lease-to-own provider and are getting the benefit of those economics. And lastly, on cost takeout, we plan to do $30 to $60 million of overhead and other operating cost takeout over the next 5 years. That's everything from supply chain to store support center to reorganizing our multi-unit leaders, and probably most importantly, this hub and spoke configuration that's going to allow us, unlike our competitors, to be able to service our markets more efficiently with less overhead in the market, but have more tentacles. And so we think that's super important. I believe the lease-to-own business needs to be transformed and the overhead needs to be rethought in that business, and this is the first step in us doing that.
Got it. And then just to give folks a sense between Aaron's and BrandSmart, I think, Kelly, if you could walk us through kind of the different margin profiles of the two businesses, and then also talk about impacts of cyclicality in terms of adding BrandSmart versus I think about the Aaron's business as relatively defensive Well, yeah, sorry.
Right, no worries. Yes, I'll hit the cyclicality first, and then I'll come back to the margin point. So our lease-to-own business, typically your first quarter, Q1, is your highest revenue and highest earnings quarter. And then your Q4 and Q2 are your second highest, roughly the same, and then your lowest revenue and lowest earnings are in the third quarter. That's largely driven by, with our typical lease-to-own consumer, they're receiving pretty significant tax refund checks in the first quarter. So that helps drive payment activity and earnings in that quarter. And then the fourth quarter is driven by demand for seasonal sales. On the BrandsMart side, it's a more balanced retail business, right? So more even through the course of the year. You do see higher revenue in the fourth quarter than you do the other quarters, but the fourth quarter also tends to be a bit more promotional. So you don't have the same kind of higher earnings in that quarter. When you put the two together, it flattens the cyclical profile of the business some, but it still is going to remain largely a first quarter highest revenue, and in second quarter and fourth quarter, the next highest revenue and then EBITDA and earnings quarters. So on the margin profile front, our lease-to-own business, the Aaron's business, it is a low 60s gross profit margin business. And from an EBITDA margin perspective, our outlook for this year is around a 8 to 9% margin. And then on the BrandsMart side, it tends to be a lower gross profit margin business. It's in the kind of mid 20s. And then for this year, we're kind of 2.5 to 3.5% EBITDA margin business. Over time, our expectation is that on a consolidated basis over the next 3 years, we're going to grow those consolidated revenues on a kind of mid to high single digit level in 2024 and 2025, and then ultimately growing margins to between 8 and 9% by 2025 on a consolidated basis.
Got it. And then, so weighing this kind of 3-year outlook and 3-year plan, how do you think about capital allocation? Obviously, you guys generate a lot of free cash flow, but in terms of investing in the business, buying back debt, or other capital returns?
No, absolutely. It's, as Douglas mentioned earlier, we do generate quite a bit of free cash flow a year. Before growth CapEx, our outlook for 2023 is between 100 and 115 million of free cash flow. Before growth CapEx, it's between 50 and 60 million after that growth CapEx. And our capital allocation approach has been largely unchanged. First, we're focused on investing in the business areas that we can drive growth top line and with earnings. So Douglas had mentioned our Gen Next strategy, our hub and spoke strategy, the growth in the BrandsMart stores, adding 1 to 2 of those a year going forward. Second, we're focused on maintaining a conservative leverage profile. So what we define that as a net debt to EBITDA ratio of between 1 and 1.5 times. We currently sit at the end of Q4 at about 1.25 net debt to EBITDA. And then third and fourth, we look to return capital to shareholders through dividends and share repurchases, and then fourth, opportunistic M&A. We have been paying a dividend consistently for quite a while. Since the completion of the spin, we have raised our dividend twice, which we did so just a few months ago. And then from a share repurchase perspective, we've purchased quite a bit over time, and then something that we would continue to look at opportunistically going forward.
All right. I'll ask one more, and then we'll turn it over to the audience. But just as you think about the consolidated, call it high single digit EBITDA margin over time, can you give us a sense for what the puts and takes would be? How do you get there faster? How do you get above that? And what would prohibit you from getting there?
Yeah, so that's a 3-year kind of time frame that we're looking at over that period of time. Some of the key drivers first on the revenue side, right, is continue looking to grow our lease portfolio in 24 and 25. We, on our last earnings call, described 2023 as being a bit of a reset year, coming off of 2 years where we had very strong kind of demand, where we had growth in the lease portfolio itself. So we see a return to lease portfolio growth in 25 and 24. We continue with our Gen Next strategy, converting our existing stores into this new format. We see a pretty consistent lift there. And on the BrandsMart side, a return to normalization and demand activity towards the end of the year and into 2024 and beyond, as well as adding 1 to 2 stores a year. that organic growth helps drive top line as we move forward. On the cost side, well, on the Aaron's business side, we've been very focused on efficiencies within the stores. Our Gen Next model, as well as this new hub and spoke model, helps drive cost savings there. We've also been very focused on cost optimization within our store support center activities. And as we move forward, increased focus on our supply chain and where we can get efficiencies there, both from an OpEx perspective as well as working capital. And then also very focused on kind of real estate opportunities and areas we can reduce costs there, and other third-party costs also. When you put those together over the next 3 years, that's how we're looking to grow margins to 8 to 9% on a consolidated basis.
Got it. Turn it over to the audience. Got time for one or two?
Hi. A couple questions. Let's say a customer buys a TV on an 18 months plan. What point do you get paid back and over that 18 months? And what is the process if you get it back in 6 months? What do you do with with a used TV? How is that disposed of? That's number 1, 2. And the last question I had is, how do you compete, or how do you differentiate yourself? You talked a little bit about the weekly versus the monthly. I'm not sure. You also compete with the subsidiary of Berkshire, right? Courts, right? Or
You're saying court rental?
right.
Yeah.
So how is that a competitive landscape given the extra bucks that they have vis-a-vis the just curious as to how do you differentiate?
Yeah, so I'll just address this. So you just important to know that this is a rental agreement. So many of our products go out, someone signs a 12, 18, 24-month agreement, and we get them back right away. I'll just start with the process of that. Typically, our charge-offs happen in the first 4 months, or our returns happen in the first 4 months. So, first-time default is our biggest sort of moment of default with our customer. And by the way, when they default, we'd like for them to return the product as a voluntary surrender, but if they choose not to return the product, there's only so many things we can do to recover it. And so what we try to do is do good underwriting, so we don't have that situation. For every 100 deals we put out on the street, about 45 of those deals return to us. And so we have the ability to bring those back in a truck. We restore them in our stores. We wipe electronics. We steam and clean other products, and we put them back on lease in our showrooms. And that's a real differentiator for us, that we can bring product back and release it again. It also provides great product price tiering within our stores, because we can say, hey, I know you can't afford this $179 a month for this new one, but I have something that's been out for a few months and just came back that we've restored, cleaned, and you get it for $99 a month. And so that's really great. In terms of the payback on the lease, it all depends on by product. So some electronics is takes longer to get paid back than potentially a piece of upholstered furniture, but it all depends on the product type.
And the competition, the competitive landscape, how do you differentiate between?
Yeah, I mean, listen, I think we've got a great differentiator. We have total optionality for the customer against other rent-to-own. I think we've got best service in the business. I think we have very competitive pricing. We have very high approval rates. Virtual rent-to-own has lower approval rates because they don't have all the infrastructure we have. And so we can spread payments over 24 months to lower the monthly payment. We can do other things to make it more valuable for the customer to do business with us. In terms of court, that's a rent-to-rent. That's just a pure rental. It tends to be a higher income customer. And buy now, pay later is really not in the competitive set with us, because it's typically a smaller product that you're spreading over 4 payments, and that the retailer is paying for it. So that's really not. Our customers come for us for big ticket items, and they come to rent their product.
Okay. Thank you, Kelly. Thank you, Douglas. Thanks, everyone, for tuning in. We're out of time, and I think we'll turn it over to Verano.
Great. Thank you very much.